Hello, my name is Jim Kahl. I'm a partner in the Washington, D.C. office of Whiteford, Taylor, and Preston. I'm also co-chair of our firm's associations, nonprofits, and political organizations practice group. Well, it's October 1st and Election Day is just over a month away. I know many of our clients are being solicited for contributions from candidates and other political committees, and they're assessing which candidates have views consistent with their corporate and industry interests and making decisions about who to financially support. Organizations are also identifying issues that will arise in Congress and in state legislatures in the new year. All of this political activity is governed by complex and often confusing laws at the federal, state, and local level. Today, I'll give you a 30-minute overview of the key political law compliance issues as we head into the end of this very busy election season. As you can see on the agenda, we'll be covering campaign finance rules, lobbying rules, and gift rules. And I'll also have some pointers for you regarding compliance issues as we continue through this very unfortunate COVID-19 pandemic. Before going into each of these issues, I always like to start with sort of a mile above the earth overview of political activity rules. It's important to keep in mind that the very same event or activity can involve federal, state, and local laws. If you have an event to which a mayor and a governor and a senator are invited, it may be necessary to look at federal, state, and local campaign finance as well as gift laws to make sure it's compliant. We're dealing here with an overlapping set of tax, lobbying, campaign finance, and ethics rules. And importantly, both organizations and individuals may have liabilities under these laws. It is an understatement to say that not only prosecutors, but the media love to follow and highlight political law violations. The key takeaway here, however, is not to avoid political activity because that may be essential to your organization's public policy goals. However, the key is to understand that there are great opportunities for your organizations if you understand the rules, and that'll also help you avoid risks and adverse publicity. So let's get started. The first topic we're going to go into are political contributions and activities. At the federal level, corporations and associations, and I'll be using the term corporate sort of to cover both, but at the federal level, corporate political contributions to candidates, political parties, and PACs are absolutely prohibited. So you can't give corporate monies to somebody running for Senate or House or to the president, or even to a federal PAC or a federal party committee. At the state level, the rules vary tremendously. A few states allow unlimited corporate contributions, and they're listed on the screen. About 20 states prohibit corporate contributions, and the others impose some sort of limits on corporate giving. Now, 501c3 organizations, charities, although they're incorporated, cannot make any political contributions or engage in any partisan political activity under the Internal Revenue Code. They are limited to certain types of nonpartisan activities, such as voter registration drives. Well, if there's a contribution restriction that is applicable to your organization, the answer may be to have a political action committee. They exist at the federal level in many states, and at the federal level, they're governed by the Federal Election Commission, the FEC. A PAC is nothing more than a separate tax-exempt entity that registers with the FEC. It's funded with voluntary contributions from eligible employees and others. This is called the restricted class. The PAC can make contributions to office holders, candidates, and other PACs, and can host fundraising events for office holders and candidates. In short, it can do all of the things that the corporation or association can't do on its own. Now, the PAC will have the organization's name as a part of the PAC name, and importantly, that PAC can receive solicitation and other administrative financial support from the organization, so it doesn't have to use precious PAC dollars to raise funds. PACs are a very well-established and safe way to contribute. They're recognized and a very, very low risk option. Yes, there are registration requirements and reporting requirements, but it is a very common and, as I said, safe way for corporations and associations to support candidates. States will have separate rules regarding PACs registered at that level, but be very careful because there is an ability to use your federal PAC in some states. However, in some of those states, separate registration and reporting rules will apply to the federal PAC, and in other states, you cannot use the federal PAC to support state candidates at all. I mentioned the restricted class, the solicitable individuals. Let's dive a little deeper into that. So at the federal level, for a corporation, the restricted class will include an organization's, and here we're talking about a corporation, will include that organization's folks who run the organization's business, such as officers, executives, managers, directors, as well as members of recognized professions like attorneys and accountants. In addition, corporate stockholders, as well as the immediate family members of all the people I just mentioned, are in the restricted class and can be solicited and give to the corporate PAC. The rules are a little different for an association. So individual association members are in the restricted class. The association's restricted class employees, its managers, supervisors, and professionals, are also in the restricted class. In addition, members of the restricted class of the corporate members of the association can be solicited if the corporate member gives permission on an annual basis. This is commonly referred to as the annual prior approval. Important note on this, a member corporation can only authorize one association PAC per year to solicit its restricted class. With respect to the contribution limits, on the screen in front of you are the main contribution limits to focus on. There are actually two different kinds of federal PACs. At the early stage, when the PAC is just registered, it's called not a multi-candidate PAC. And as it gets a bit larger, it's considered a multi-candidate PAC. The most significant difference is on the amount that the multi-candidate PAC can give to a candidate. As you can see, the multi-candidate PAC can give $5,000 per candidate per election, whereas the not multi-candidate PAC can only give $2,800. And at the federal level, a primary and a general election are considered separate elections. So in an election cycle, a multi-candidate PAC could give $10,000 to a candidate in that election cycle. A couple of important things to remember in regard to contributions. First of all, conduit or straw man contributions are absolutely prohibited. So an organization can't funnel contributions through a legal contributor as a way to circumvent a contribution prohibition. In other words, a corporation couldn't reimburse an employee for their personal political contributions, nor could they provide them the funds through salary increases, bonuses, or other means that are intended to funnel corporate money to the candidate. Secondly, foreign nationals, both individuals and organizations, are absolutely prohibited from making contributions in connection with any election, federal, state, or local. The only individuals who can contribute to candidates, political parties, and to PACs are U.S. citizens and lawful permanent residents, often called green card holders. Employees who might be on a long-term visa do not qualify and cannot make contributions. Another restriction to keep in mind is called corporate facilitation, which is a term that the FEC uses. And the concept goes like this. Not only can the corporation not make contributions to federal candidates, but the corporation's facilities and resources cannot be used for fundraising activities. This normally takes the form of let's say a vice president of a company who wants to raise funds for somebody who's running for office, and he or she will use the customer list, will use the company letterhead to send solicitation letters, will use company mailers to forward checks to the campaign, and might even use his assistant's time in sending letters out to collect contributions. The problem here is that the use of all of those corporate resources, the value of those resources, are treated as an illegal in-kind corporate contribution. Now, this is a very common corporate violation, and unfortunately, it is an area where the highest civil penalties issued by the FEC have occurred. States recognize this type of violation as well. They don't tend to use the term corporate facilitation. They just call it an in-kind contribution. Keep in mind, there are some exceptions for de minimis use of corporate facilities. So by and large, you're allowed to use your company phone to call individuals if you're confirming whether they're coming to a fundraiser that you're having at your house over the weekend. That kind of de minimis activity, as well as use of your company computer, will not result in a corporate facilitation violation. Now, having said that, there are still many opportunities for organizations to interact with and invite candidates and office holders to come to their facilities to meet with employees and with others. So, for example, a corporation could pay the cost to have a candidate appear before the company's restricted class, and that event is not treated as a contribution at all to the candidate. The organization can endorse the candidate at the event if they so choose. The candidate or representative of the candidate can solicit contributions and collect them. And the company might even suggest that restricted class members contribute to the candidate. Big qualification here is that the company cannot collect the money. That must be done by the candidate or his or her representative. Now, again, a 501c3 organization could not take advantage of this rule due to the tax rules. There are also events to which a company or an association can invite a public official where they're not appearing in their capacity as a candidate, and that's not treated as a contribution to the candidate's campaign. So, for example, it might be that you're inviting the chairman of a congressional committee with expertise in a particular subject matter, and that's the subject of the forum that is taking place, and that's permissible. A couple of key points to note here is that communications relating to the event could not expressly advocate for any candidate or endorse any candidate. The candidacy basically cannot be discussed at this issue forum, and there can be no solicitation of contributions or encouraging or collecting contributions taking place at this type of event. Now, I'd like to turn our attention to a very specialized form of political contribution restriction, and these are called pay-to-play laws. Pay-to-play laws, in a nutshell, prohibit or restrict political contributions by state and local contractors and bidders to a designated set of candidates and office holders. These restrictions, these laws, can apply to contributions by the company itself, by the company and its PAC, and sometimes they extend to the company officers, directors, senior managers, and even the spouses and children of those company officials. So it's very expansive contribution restriction. In addition to the prohibition on the contributions, there may be registration or reporting requirements that go along with pay-to-play laws. The big deal about pay-to-play laws is the potential sanctions. It's not just a fine. Companies that violate the pay-to-play laws may have their bids disqualified, may have their contracts voided. They can be even barred from future contracts. In addition, there are fines and criminal penalties for knowing and willful violations. Pay-to-play laws are followed very closely by the press, and so one of the other possible negative consequences here are severe reputational damage to the organization due to adverse public publicity. On the screen are a list of states that have pay-to-play laws, and the state list there is complete. There's a sampling of localities that have pay-to-play laws, and it is just a sampling. There are literally thousands of pay-to-play laws that exist across the country. Now, turning our attention away from political contributions, I'd like to say just a few words about candidate advocacy communications. The term of art used at the federal level and in many states is independent expenditures. Since 2010 in the Citizens United decision, there is now no limit on the amount that incorporated entities can expend for communications that advocate for or against candidates and political parties. However, these expenditures cannot be coordinated with the candidate or political party in any way. So there can't be discussions between the candidate and the party sponsoring the communication about the content, timing, or anything relating to those communications. In other words, the expenditures must truly be independent. Now, it probably doesn't come as any surprise that many corporations choose not to independently on their own sponsor candidate advocacy communications. Rather, it's more common that such independent expenditures are conducted through intermediaries like trade associations, 501c4 advocacy organizations, or super PACs that are set up specifically to sponsor independent expenditures. The main issue in this area is one of disclosure. Certainly the organization, the intermediary as I call it, that's sponsoring the communication is going to have to file a report of some kind with the FEC or the state regulator. But when it comes to disclosure of the persons and entities that contribute to that intermediary, here's where the laws vary greatly. At the federal level, the FEC says that donors who financially support an organization's political activities knowingly do that must be disclosed in that organization's independent expenditure reports as donors. Many states also require the disclosure of those ultimate donors. In California, New York, and Minnesota are good examples of states that have those kinds of disclosure requirements. The important takeaway here is that if your organization is going to be sponsoring directly or indirectly candidate advocacy communications, it is important to understand the disclosure rules in advance so you're not surprised when your organization is listed as a donor. So let's turn our attention now to our second topic, and that's lobbying laws and rules. The lobbying laws and rules differ tremendously across the country, and there's different registration and reporting triggers at each level. The law at the federal level is called the Lobbying Disclosure Act. If I had to choose one word to describe the trends, overall trends in the lobbying area over the past 10 years, it would be more. What we're seeing is that there is an expansion in the definition of what is lobbying, particularly at the state level. We're seeing more disclosure required about lobbying activities. We're seeing more political contribution and gift restrictions imposed on lobbyists. And we're seeing more collateral obligations like mandatory ethics training and sexual harassment training for lobbyists that are being required. We're also seeing over a 10, 12-year period, stricter penalties for violations at the federal and state levels. On the screen in front of you now is the test of when an organization and individual need to register under the Federal Lobbying Disclosure Act. It's a fairly complicated test, so let me walk through this with you. So under federal law, an entity is required to register if you have an employee that meets a two-part test. If the employee makes 2 or more lobbying contacts, direct communications with legislative or executive officials about matters such as laws, rules, regulations, and if that employee spends 20% or more of his or her time on lobbying activity in any 3-month period, then that person is going to qualify as a lobbyist. Important thing here is lobbying activity for the 20% test includes more than direct communications with legislative or executive officials. It includes behind the scenes preparation time, strategy time, all the things that support those lobbying communications. Then, if the organization has spent more than $13,000 in lobbying expenses in a calendar quarter, then the organization registers with Congress as a lobbying organization, and that individual who meets the two-part test is listed as the lobbyist in the reports. Any subsequent employee who comes along and meets those first two parts of the test here, they're also listed as employees. It's a complicated test. However, the takeaway here is that you have a threshold below which no registration is required, and that may be enough for your organization. You may not need to have anybody spend more than 20% of their time on activity, and your company may never have to register under the Lobbying Disclosure Act. And that's significant for a number of reasons, none the least of which is that there are many obligations that go along with being a lobbying organization. For example, there is a ban on gifts from lobbyists and lobbyist employers to members of Congress and staffers. There are a number of exceptions, which we'll get to in just a bit. The lobbying organization is going to have to file quarterly reports about lobbying activities and expenses. The registrant is going to have to file semi-annual contribution reports that disclose other kinds of payments that are made relating to public officials. Also, there are many regulatory sanctions that go along with the Lobbying Disclosure Act. There are random audits of lobbying reports conducted by the General Accountability Office. Penalties can range up to $200,000 per violation, and knowing and willful violations can have felony implications. And DOJ is now enforcing this law through many prominent prosecutions recently. At the state level, as I mentioned, the laws vary differently, and here is where the states are pushing the very definition of about what is lobbying. It's not just going to the state legislature to talk about a bill. Some states regulate what's called goodwill lobbying, and here we're talking about meeting with a public official to build relationships, even though there's no attempt to influence a particular matter or even discuss a particular law, rule, or regulation. It's just relationship building, but that may be enough to require registration. Other states regulate what's called procurement lobbying. Here, these are attempts to influence the purchasing or procurement decisions by government agencies. And more than 26 states and many municipalities have these laws. So what we're talking about is folks who are government sales professionals may have to register and report as lobbyists. In other states, interactions with state economic development agencies, for example, to obtain tax breaks or concessions, those interactions can be regulated as lobbying as well. Turning to our third subject, gift giving to public officials. It is an understatement to say that this area is highly regulated at the federal, state, and local level. There are gift and ethics rules that cover gifts to elected and appointed legislative and executive branch officials, as well as to career employees. The operative assumption should be that a gift is anything of value that you might give to a public official, anything of value. And in some states, such as Florida, a lobbyist giving a cup of coffee to a state legislator would be an illegal gift. Fortunately, in virtually every set of gift restrictions, there are many exceptions. They tend to be highly specific, and they need to be followed to a T, but they often allow a wide range of permissible gift giving. These are great opportunities for your organization to interact with public officials in various kinds of settings, but the key is advanced planning is essential, because without the advanced planning and following these exceptions, as I said, to a T, you could stumble into inadvertent violations of ethics rules. To give you a flavor of the multi-tiered approach to these laws, and I'm not going to go through all of these in great detail, but at the federal level, There are House and Senate gift rules. They're different, unfortunately, and need to be looked at quite carefully. With respect to federal executive branch officials, all federal employees are covered by ethics rules issued by the Office of Government Ethics, and political appointees of the president are subject to an executive order which greatly limits gifts from lobbyists or their employers. Very few exceptions exist at that level. Some of the common gift exceptions, as I mentioned earlier, are here on the screen. Again, they need to be looked at carefully, and these types of are the common exceptions you'll see at the federal level and the state level. So, for example, widely attended industry gatherings where industry and government officials come together to discuss issues. You can normally invite a public official to attend, to speak, and oftentimes provide meals and beverages while they are there. Under some laws, including the federal law, stand-up receptions with finger food and cocktails can be provided to members of Congress and staffers. Other exceptions include invitations to charitable fundraising events, and of course, different kinds of giveaway items, such as promotional items or commemorative items that are given to an official when they visit a site, or informational materials about your industry or your business that will help them in their undertaking their official duties. All of those are very common exceptions, but again, read the exceptions carefully and follow them to a T. Finally, just wanted to touch on a few issues that come up in the compliance world due to the very unfortunate pandemic that we continue to suffer through. At the federal level, keep in mind that the FEC cannot extend PAC report filing deadlines. Those deadlines are set by law, and the agency cannot waive them. The FEC electronic filing system has not been impacted during COVID-19, and so the reports are being processed and reviewed. FEC employees, like most of us, are working remotely now, but the Information Division and Reports Analysis Division employees can be contacted by telephone for advice, and they are readily available. The lobbying reports, which are filed with Congress electronically, have not been impacted during the crisis. At the state level, it's important to check with the regulators regarding their filing procedures. In some cases, they've had to change, especially with respect to paper filings with state regulators. In some states, reports and documents had to be notarized in the past. There have been waivers of notarization requirements, and in some cases, alternative procedures for obtaining sworn statements have been put in place. So check those very, very carefully. If you have any questions about today's webinar, my contact information is on the screen. I'd be more than happy to answer your questions. I hope this has been a useful session for you. Thank you so much for taking the time to view this webinar. Thank you.